Okay, here's a third example of the statement of financial position, and we're looking at impairment of goodwill again. So what we're going to do this time, we're going to use the point of departure, or as a point of departure, the balance sheet that we arrived at last time when we impaired goodwill by 20%, giving us a figure of 3,800 to deduct from the goodwill amount. And here you see the adjusted statement of financial position that we created. So this is the 15,200, which is the original goodwill minus 20%. So it's been impaired down to 15,200. And then we shared the impairment 75%, 25% between the parent and the NCI, and that figure was taken off their retained earnings. So these figures, 64650 is here, and the NCI's 10550 is here. So what we're going to do this time is we're just going to change how the NCI's contribution is assessed, and instead of giving a absolute figure, we are going to say its contribution is a proportion of net assets. Net assets, proportion of net assets. Obviously of the subsidiary at the date of acquisition. So that's going to change these figures, which is then going to change all our other figures, but we can do it quite quickly. It's only really one or two little adjustments, and we'll build a third statement of financial position, and you can see the differences between them. So let's just see what the differences are. The contribution of the NCI is the first one. So instead of being given a figure of 9,000, we have to calculate this, and it's 25% of the net assets, which was, we can do that here, plus 25% times, so first net asset was the 10,000 equity shares, and then on top of that we had the subsidiaries retained earnings at the date of acquisition, which was another 10,000. So that means our contribution now from the NCI is only £5,000. So that's a drop from the 9,000 we previously had. And that is obviously going to change goodwill. It was 19,000. Then in our new estimate it was 1520. And now it's 1,500 using this scenario. The impairment therefore has dropped to 3,000. It's still 20% of the goodwill calculation, which gives goodwill figure of 12,000 all in. So I can put this here and build a new balance sheet. These won't change, of course. Other assets exactly the same as before. So let's sum these two together to give us our total assets. That comes to 10,900, 109,000. So you can see that's already very different from these two original figures. Let's keep building. The 1,000 equity shares is just the same, parent only as always. So now retained earnings. What do we do here? Well, the calculation down to this point hasn't changed. The retained earnings is still the same, less the impairment. Now, in our previous example, we shared the impairment between the parent, which is this part of the calculation, and the NCI, which is this part of the calculation. But if you remember back, when we calculate NCI's contribution as a proportion of net assets, all they've done is paid for 10,000 of equity shares, 10,000 of retained earnings, and they've just paid their 25% of that. They've not paid anything over that to pay for the goodwill. So the entire amount of the goodwill, 12,000 here, is therefore put towards the parent, and none of it is attributed to the NCI in this scenario. So it's just the way we're looking at the NCI contribution that decides whether the goodwill goes to the parent only or whether it's shared. So what we can do here, not only does the parent have or take all the goodwill, it also therefore takes all the impairment. So instead of its share of the impairment as previously, we're just going to take the full impairment, negative 3,000. Oops, make that negative 3,000. So we're dropping from 67,500 to 3,000. Sorry, by 3,000 to 64,500. So we can put that in there as the new figure for retained earnings. And you see again that has dropped from the previous scenario because we're now taking the full amount of the impairment. And the NCI amount, well, that's now not taking any impairment at all. So we can get rid of this. Let's get rid of that. And it's just the original figure of 11,500. Contribution, yeah, let me just make sure that's right. Contribution is now only 5,000. The NCI's share of the profits, that's not changed. So that gives the NCI's figure there of 7,500, and then we can quickly sum that, and then we're almost done on the balance sheet. Just tidy that up. Liabilities, as always, parent plus subsidiary, and we'll add the equity portion to the liabilities, 109,000. It's always a nice feeling when that balances. And there we go. So what's happened here, just to recap, because of the way that we calculated the contribution, it means that the NCI was not liable or did not have attributed to it any of the goodwill, because it only paid for the assets or a proportion of the assets and didn't make any overpayment to pay for the goodwill. So not only does it not receive the goodwill, it also doesn't receive any of the impairment. So we made the impairment calculation, or we made the goodwill calculation, which was now different. The impairment based on that goodwill was 3,000. Gives a total goodwill of 12, which is brought in up here. Then the parent's retained earnings was reduced by the entire amount of the impairment. So this 3,000 figure was brought in here. So that means here the parent's retained earnings is the lowest of these three figures, and that makes sense because it's taking the full amount of the impairment. And the NCI is not taking any impairment at all because they didn't pay any for any of the goodwill. So that's just a simple 7,500 figure, giving the balance sheet as you see it here. So that is the impairment of goodwill when the NCI is calculated using a proportion of net assets.